Lulu, what are the drivers that we're seeing for this trend?
Well, the region's hedge funds are looking beyond listed companies because it's harder to generate the type of returns that investors are seeing in private markets. We are seeing that private companies, especially the recent raft of unicorns that we've seen, they're staying as private companies longer and becoming significant in size, especially with the help of investment funds like Tiger Global and SoftBank. So we're seeing a proliferation of this trend where hedge funds are venturing into private investment much earlier and not just focusing on the public market that they used to be in.
Specifically, what kind of investments are they interested in?
Well, most of them are looking at investments in companies where they're 3 years prior to listing. That said, some could be even earlier. I think Asia is a pretty rich hunting ground for a lot of these hedge funds because out of the global unicorns, the world's 700 or so private companies that are more than $1 billion, more than a quarter of them are in Asia.
Lulu, there are very different risk profiles with this type of investing, right?
Yeah, that is true. I think the risks, there will be risks just like in public market investing, but I think the risks here that these companies will be facing is the chances that these companies might not go public, a slash in valuation. We do see that private markets tend to have more frothy valuations these days. And then also there's a conflict of interest risk as well. If they share information gathered from private markets and use it for public market trading, there could be potential violations. And we are seeing like firms ring fence their private investments in so-called side pockets and also create internal firewalls to avoid some of these complications.